Good afternoon, this is Bob Iaccino coming to you from the CME Group trading floor in Chicago, talking energy. Stock crude oil up a little bit over 1% today, 1.08 to be exact, 69.30 on the close, 69.70 high. Not quite getting up to that $70 range, but considering it's Wednesday, it's a pretty strong start for the week, up 2 consecutive sessions after 2 down weeks. So we could be reversing this little bit of a bear trend we've been in the last 2 weeks. EIA stockpiles came out today. Now, a lot to sift through in that EIA number. We had a larger than expected draw of 6.1 million barrels. Market was expecting a draw, but it was expecting it to be about 2.9 billion barrels. We also had a draw on gasoline of a little over 2 million barrels, with the market expecting less than that. That helped push an already rallying crude market. WTI was only up a little bit under 0.5% when that data came out. But there was a lot more that went on in that data than just that. We saw reduced imports of both crude oil and gasoline into the U.S., so that took stockpiles down a little bit. Now, interestingly enough, we are below the 5-year average by about 4% on crude oil, but we're above the 5-year average on gasoline for this time of year. So there is a little bit of an imbalance there. And if you want to talk a couple of other bearish things on a pretty strong day, refinery utilization, RU fell to 93.8%. That's the 5th straight decline now in the EIA figures of refinery utilization. So that could indicate a little bit of slowing demand, along with this slight build that we've seen over time in gasoline inventories, not in this week's data, but again, being above the 5-year average in gasoline inventories could start pushing that crack spread a little bit, pressuring that crack spread if you get movement diverging between gasoline and crude oil. Right now, crude oil definitely on a bull track for this week, but certainly could turn around if you get a little bit of easing of the U.S. stance in Iran or some sort of shift in Saudi Arabia or Russia. But right now, the EIA data, the API data, all showed larger than expected draws. But again, keep an eye on that RU number. That refinery utilization has been trending lower, meaning less product is being called for on those refineries. It's trending from a very high level. 97.5 was the number we saw 6 weeks ago now at this point. And that was the 36th highest refinery utilization number we've seen, which may not sound like a lot, but the EIA started reporting that piece of data in 1990, considering that it comes out every single week without fail. That was 1,446 pieces of data, and this was the 36th highest. So coming from a high level, but still down for the 5th straight week. This is Bob Iaccino talking crude oil on an up 1% day from the CME Group trading floor in Chicago.